I think you have to be sick to be a founder.
And I've got this belief that for every successful business, there was a moment where you were 5 minutes away from hanging it up. And you're smiling like most founders do when I ask this question. What's that moment for you?
I think it was in 2017. I remember having a conversation with my co-founders, Brian and Chris. And I was like, hey guys, I just want to let you know, I think I'm out. This is just too hard. We're getting beat down after beat down. And we have just enough clients now where it sucks to close this. And I was like, I'm pretty sure my gym can make more money than this business. I was super convinced. I'm like, I'm just going to focus on the gym because the gym definitely has a better chance.
Dan Uyemura, founder, CEO of PushPress. Welcome to the pod, man. Super excited to have you on.
Thanks for having me. I'm sure we'll talk about it, but we go way back. So it's always good to chat with you, my buddy.
I mean, let's start there, dude. So we were kind of coming up in the fitness software space in the same time. And I think we've had just like a few random encounters, knew a lot of the same people, right? But, you know, I think we first met in person at a brewery in Baltimore when you were out there for a conference. But I don't know, man, my favorite set of hang time, we did like a joint company retreat with our two businesses. And I think it was 2017 and shared a house. And I don't know, we crammed like 112 people into like a 4-bedroom house.
Good old days.
They're just hanging.
The bootstrap days.
Yeah, man. Yeah, for sure. And God, it's so funny, man. Just hanging by the pool, talking shop, laptops open, whiteboard and stuff, figuring out how to integrate products. It was a lot of fun, man. It was some good times.
Yeah, I mean, that's the epitome of bootstrapping, right? Like just get people together any way you can and just brainstorm the best products you can as fast as you can get to market. And that's what we're doing.
Yeah, man, it's super cool. So I would love to know, I always laugh when I think about our early days kind of alongside one another, because we used to do Zoom calls, catching up and whatnot when you were running the business out of the gym. And I remember every time, I don't remember what day it was, but you always be like, oh, sorry, it's deadlift day. Because we'd be talking on Zoom and it would just be like, bam, bam, just like deadlifts going. It's like humble beginnings, bootstrapped company. I think that you are the classic story of somebody who is in an industry that's not software, right? I mean, you were running the gym and saw this problem or this gap in the market and weren't satisfied with any of the solutions out there. And you did what any entrepreneurial person does and went and built the thing. So I'd love to just, set context for the people listening. What's the origin story of PushPress? I mean, you've gone from that to 8 figures and beyond, man. It's been a wild ride.
Yeah. I mean, I guess I had an upper hand in it, and the fact that I was a internet engineer as a career. I burnt out of basically just sitting at a desk coding. I was working for a bunch of companies. I didn't really believe in the product I was building. So it was kind of whack. Like I would just show up every day, write some code, go home. Or somewhere in that journey, I found CrossFit. And so I would show up every day, write some code, get pissed off that they held a meeting at 4:30 p.m. when my 5 o'clock CrossFit class is about to kick off. And then eventually I was just like, I'm kind of done being a coder. I got laid off. I was working at MySpace of all places. Let me date myself. A lot of gray hair. I was working at MySpace. I got laid off because they were doing typical PE stuff where they were like restructuring the company and trying to sell it to someone else and put lipstick on a pig. And anyway, I got laid off. Took my severance because I got a severance and decided to open a gym. When I opened the gym, I realized two things. One, gym owners not only needed a lot of help, but we were getting ripped off. So while I was still at MySpace, I was negotiating a payments rate for this gym with the payment provider company that was attached to the software I was looking to use. And I spent about a month of my life negotiating this payments rate, got it down to 1.9%, super stoked. About 3 months later, one of my initial members came in who was a banker. I was bragging about it to him because that's what we do. And he told me it was impossible, that there was no way I was paying 1.9%. It was just not possible unless I was like doing card present transactions, which I wasn't. He took my bank statement, analyzed it, and we realized I was paying 4.8 in effect. And so and then I started asking other gym owners and they were all in the same boat. So I realized like this salesperson who had way more information and was better at sales than me ripped me off. And no one was the wiser. And it was happening to probably thousands of other gym owners out there concurrently. Nobody knew. So that was one realization I had, which really, really pissed me off. Second realization I had was like, because I built software, I knew all the software solutions that were in play at the time were woefully far apart from what I knew could be built. And so I kind of took those two things and married them together and said, hey, why don't we try and build the software? We took about a year and a half, threw away like 3 different versions of the code, and ended up launching our first version of PushPress with my second gym, which was Torrance Training Lab in Torrance, California. So that's kind of the backstory.
Yeah. What year was that? Did PushPress come to market? Just kind of
2013.
paint the picture. 2013. Cool. I love it. And so you launched from there. It was you, Chris. So like, what was the team when you guys went to market? It was just a handful
Me,
of you
Chris,
guys,
and
right?
Brian. Brian was the banker,
Yep.
ironically, who
Yep.
pointed that out. Yeah.
Oh, got it. And I remember, I remember we were playing top golf, talking shop,
Yeah.
when Brian was there. That's cool. And so fast forward today, 11 years later now, as we're recording this podcast, I mean, whatever you're comfortable sharing, but like, I mean, you guys are above 8 figures in revenue. You got a whole suite of products. Like, what's the rise been for you guys?
I mean, it's been the typical bootstrap journey. If you're out there on the bootstrap journey, it's like a ton of grind in the beginning. It's so hard to build the momentum you need to get to market. It always feels like you're rounding third, and then you realize you're still at home plate, like trying to get a bat off your shoulder. I mean, this probably resonates with you and everyone else listening, but there are so many times where we're like, whoa, when we get to 500,000 in revenue, we're going to be good.
Yeah.
Oh no, when we get to 1 million in revenue, we'll be good. Oh, we did the numbers. When we get to 3 million in revenue, we'll be able to hire the people we need to be good. And it just never stops. I mean, I'm still there today. So yeah, I mean, growth in the early years was like 100, 200% a year. But what is 200% when you have like 10 clients? Like, who knows? But it's hard. It's hard. I tell a lot of, people starting businesses now, it's like, you're basically going to get punched in the face every day. Like you're in the ring against Max Holloway, and you haven't even trained.
Never fought before.
So it's like, you're fucking lucky if you can block a punch in the beginning. Yeah. And then eventually you'll start to learn how to like at least throw a punch. And then maybe you might land one. And then 10 years in, you might be able to like actually compete. That's the type of grind I think you've got to be willing to do to get into a business, because it's very competitive, and not just against your competitors, but winning customers and satisfying customers is the game, and it's hard. It's a hard thing to do.
I want to double click on that for a second about the grit or the staying power. Dan, I've got this belief that for every successful business, there was a moment where you were 5 minutes away from hanging it up and being like, yo, I'm out. This is too much. And you're smiling like most founders do when I ask this question. What's that moment for you?
Dude, it's so ridiculous in hindsight. But I think it was in 2017. I remember having a conversation with my co-founders, Brian and Chris. And I was like, hey guys, I just want to let you know, I think I'm out. This is just too hard. It's like we're getting beat down after beat down, and we have just enough clients now where it sucks to close this. Like we probably had like 300 clients, and it's like not enough to really make money, but just enough where you're like, closing this is going to suck. And I was like, because I'm pretty sure my gym can make more money than this business. So I think I'm going to focus on the gym, which nowadays makes me laugh so much. But I was super convinced. I'm like, I'm just going to focus on the gym because the gym definitely has a better chance than the software company. But they didn't let me, thank God. So.
And what was behind it? What led up to that?
Man, it's just, again, getting momentum is hard. And it's like in the early days, you might win a client. That's great. It's an emotional roller coaster. It's like you win a client, you're stoked. And then 3 other clients are like pissed off, punching you in the face, or you lose a deal to someone else, or, it's just like in there, not even in the early days, just the way business, what I've learned now is the way business works is it's just a series of losses. And if you're customer obsessed, the more customer obsessed you are, the more you're going to lose, because any pain point someone has, you're going to feel personally. And I'm customer obsessed. So it was like, we might've done one thing right, but we had 99 things we had as a problem, and then 2 things right, and 98. And you just slowly start to make that 50-50, but there's still 50% of the things people are not happy about. To this day, like, I think we have a decade worth of product to build still. Like, it's just no end in sight. The difference now is like, I realize that there's no end in sight, and I'm not trying to, it's like you play the game differently when you realize, like, I'm never going to wake up and have a great day. Like there's always,
and it goes back to what you said earlier, right? Where it's like, oh, when I get to this revenue level or this headcount or this feature or this product, I'll be good. It's just never. It's forever. Yeah.
I bet you if you ask Bezos isn't running the company today, but if you ask Bezos when he was still running the company the day before he quit, he probably had a laundry list of things he needed to do to feel like he actually had the company going at that point. And they're probably already at, billions in revenue. So it just never is going to end.
Yeah. And in a few minutes, I want to get super specific on kind of how you look at those, but there's something I want to hit before that, man, because, I'm a big believer in the law of the lid, right? Like the company's never going to grow faster than you grow. And you tweeted something a while back, about how the guys at your VC firm who did your Series A, they really revere Warren Buffett, right? And you asked them how you can dig deeper, and they were like, just read the shareholders' letters. And you had this point you were making about how it's amazing to you how simple the answers are and how much wisdom is in the world. And it doesn't always cost you anything. You just have to be curious and carve out the time to go learn it. And I thought that was a really cool insight. I'm curious, like, when you look back at who you were in 2017, when, you know, Chris and Brian pulled you back from the brink of hanging it up in PushPress, right? Who did you need to become in order to be the guy now who's CEO in this company today?
Man, that's a good question. I've literally probably gone through 3 metamorphoses since then, at least. And I'm in the process of doing another one right now.
Tell us more.
Yeah.
Man.
So, I mean, the reality is like going from 0 to 1 requires passion, grit, determination, running through walls, like just doing anything you can to get to 1. And I'm not talking in any revenue terms, just like 0,
Yeah.
first product.
I have a product, it exists. Like, yeah, I've arrived.
I mean, I guess we could break it down into different phases, right? 0 to 1, first customer, right? Like it took a year and a half of writing code. From first customer to 1,000 customers, you've got to go from like, you've got to actually put on a salesman hat. You've got to like put on a marketing hat. Now you have to do all of these things to actually get business to work and listen to customers and build functionality and do all these things. Like you're doing everything. There's not enough hours in the day to get from like, I don't know, 1,000 to 3,000 customers for us, right? Now you got to become a team builder and a leader, and you've got to learn how to allocate capital, and you've got to learn about unit economics and business models, right? And there's just so much more there. And like the next journey of mine is like, how do you build a machine where there's an input and an output, and it's all mathematically determined? How do you foster operational excellence? How do you do annual planning? How do you think of a 5-year plan? Like now it's like, I'm not thinking it personally. Before I would think in like minutes, and then it'd be like days, weeks, quarters. And then you're thinking annually. And now it's like, I can't even think annually. Like I'm already focused on 2026 at this point. 2025 is already burnt and spent. Like we've already got 2025 in the books. And it's like, how do you plan 2026 and 2027? And like, I'm steering on such a big trajectory. It's like, I've got to start steering now to get 2026 going. So I've got to know where I want to get in 2027 to know where 2020, it's like, you're starting to think in like in 3 to 5 year chunks, which is crazy. So
yeah, and it's such a massive step change, I think, from where so many entrepreneurs are. Because I guarantee you, there's 1,000 people listening to this who are just like, that sounds neat, but I'm trying to make it to Tuesday.
Yes,
right.
That's what I'm saying. Like thinking in minutes in the beginning, right?
Yeah,
and that's the right thing to do. You have to be so nimble. And this is where companies, and we could talk about this later, but where companies start to fail when they get to our stage is like you become too slow to make the turn. So you've got to build into your business the mechanism to be nimble and agile and responsive to the markets and your customers, but at the same time you're thinking far enough ahead where you're able to get the big steers happening early enough.
Yeah. So no, I want to talk about that, man. So you're saying that one of the most important things as you become a big business is to make sure that you are still nimble enough to adapt to the market and make quick decisions.
Or else you're going to get clipped by a startup if not.
Totally. But how? Like, how do you build that into the company?
Yeah. So for us personally, the way I'm approaching it is trying to build a bottoms up company. So and this is where like my big steers are setting framework, right? So what is the objective of 2025? It has to be super clear. It has to be understandable, and it has to be measurable. But then I'm not telling them what to do other than like, in 2025, we need to do this. Like, I want to see customers happier. I want to see logos increase in different verticals, whatever it might be. Like you give them the guardrails, and then you build the operational processes and facilities so that it's like, figure it out. I don't know how you're going to do it, but that's what we want to do. And what you end up at this stage, what you end up like attracting are problem solvers. Like, I don't know if they're entrepreneurs or whatever, but basically highly curious people who have customer empathy and want to solve problems. They're like, okay, the big picture for the company is to do X. I work on the mobile team, specifically the members app of the mobile team. And my contribution to X will be to do this thing. I'm going to go research it. I'm going to go figure out what KPIs I'm measured against. I'm going to figure out like the mechanisms for building this. I might have to figure out the resources I need. And then I'll write a pitch for that. and I'll present that to the executives and they'll approve it or not, or they'll question things and refine it with me. And then I'll have clarity on what I need to do in 2025, and I'll build the team in Q4, and then 2025, we're off and running. But that's how you can stay nimble enough, because you're empowering all the little micro divisions in your team to figure out what the market wants, what the customer wants, and how that aligns with what the company needs.
Yeah, dude, I love that. And I'm curious, how do you build the environment where someone who's entrepreneurial enough to come up with a pitch for a product idea, like how do you make them want to build it with you?
I mean, I think a lot of highly creative people and highly passionate, ambitious people are looking for like agency and autonomy. So they're looking for the ability to attach. Well, so one thing that's cool about my company specifically is 10 to 20% of the population identify as a fitness person. So it's like you're tapping into some intrinsic like passion that they have. I want to make the world fitter with me. You're one of them, right? So that's the first part, is like, I believe in what we're building. And then you just got to build systems and the frameworks within your business to say like, you believe in what we're building. I don't have to sell you on like what tomorrow looks like. Like, to be honest, when I worked at a Pinterest agency for a while, I don't think I ever bought into like where they wanted to go. I'm like, I just don't care.
Yeah.
I'm just here to make money, right? So we eliminate that from the start. It's like missionaries, not mercenaries, from the get-go, which means you have to have your core values established. You have to have your mission, your vision, your values, and like where you're going with very clear, so that when you're hiring people, you're weeding people out against like, do you align with this? For example, fitness is one for us. The other one for us that I will interview against and try and root out against is like, do you believe in the little guy or do you like the big guy? Give me an example, right? Like, did your mom own a laundromat? Did your dad own a restaurant? You know, like, did he get pushed out of town by Chili's? Right? Like, show me something like that, because we support the little guy, right?
Yeah. And just for what it's worth, like, I can see that like oozing from your marketing, from your content, from your positioning on social, just when you talk, when you speak about the industry, like it's a lived value for you, man. I can see it from 1,000 miles away. It's pretty awesome to see.
So there's magic in that. Like, if you can actually truly identify, and it's okay if your identity is like, we're the big guy. Like, it doesn't matter what your identity and your mission, vision, values are, as long as they're set and they're stable, and people will be attracted to it. And the right people. So anyway, that's the first thing. And then it's about building the process, which we're working on now. We're not great at it, but again, like annual planning. What is the big picture for the company for the year? And then we work that down to the company. And then every division is just expected to say like, go put on your entrepreneur hat, figure it out. Like, what does the customer need who do you work with? What do they need? What are they saying? How are they feeling? How does that tie into where we want to go? Right. And then what is your proposal on how to solve that? I think, that's how you can stay nimble as a company, even though like I'm steering 2027 right now. We've already we've set up 2025 and 2026 to start going towards that. People can start to build those processes. And then,
got it.
Yeah. It's a lot of it comes back to hiring. Like, you've got to hire curious people who are passionate and have high potential.
So let's talk about this product strategy then, right? Because I feel like from what I've seen of your company, it's not just innovating within a single product. Like we mentioned earlier, you've got a whole suite of products at this point. And some of them I felt like if I put my gym owner hat on, they were relatively, logical, and there's a really strong value prop. But if I have my software hat on, like the guy who does the billing platform, it's a non-obvious play to, for instance, offer gym insurance, right? And, I'm curious, like, first off, what is your vision for the industry? You're talking about thinking big, 3 to 5 year, plans. Like, what's your vision for the fitness industry overall and your role in it? And then I want to talk a little bit about your strategy with the products you're launching.
Vision for the fitness industry in general, and this isn't fitness specific. This is, I think, all vertical SaaS that are SMB focused, which is us. So if you're watching this and that's you, this is the understood playbook today, but this is not the understood playbook when me and Matt were hanging out in Vegas trying to figure out what the fuck to build. Yeah. The bottom line is this: small businesses do not want to have more relationships. They prefer less relationships over more. And they are highly loyal to the relationships that they trust. So our mission is to establish trust by building value towards our customers and caring about them more than they care about themselves. When you establish that trust, you earn the right to solve all their problems. And the beauty about being in the center of what they do, we are the operating system for a gym, is we can solve their problems with more efficiency in a way that's generally provides more value at a cheaper price because we have their core data. We understand them better than anyone else, and which means we can usually sell it at a price that's cheaper than anyone else can do. So you can create this perfect, I don't know if it's a trifecta. I haven't really worked this out in my brain, but the bottom line is like, because we know them better than anyone else, because we have the data that backs up how we know them, and because we truly are passionate about their success, like those things line up, we can sell them all the services that they need in a way that protects them better than an outside company would, has their interest more at heart, is usually at a cheaper price, and provides more value because you have 1 + 1 = 3 type economies happening all over the place. That's the vertical SaaS playbook that we are executing right now.
I love it. And there's some nuance in the sequencing that I want to just shine a light on, and we'll talk about your specific strategy as we get into this. But it was build the operating system first, right? Build the system of record first. And in the gym case, it was billing. I think it's a pretty accurate statement to say it's usually where the transaction happens. You've got to be able to close the ROI loop and work your way out from there. And so what you're saying, correct me if I'm wrong, is that the vertical SaaS play, build the OS, get the actual like workflow management and transaction stuff figured out. And that lets you be more efficient in building on like the quote unquote bolt on additional products that layer on top of the platform. Is that kind of the right methodology?
Correct. Yeah. You want to be the center, the hub of the relationship with that customer. And usually that does tie into the billing or whatever their core business. It's really whatever their core business motions are. And in most businesses, that includes a payments stack.
Cool. And so we're shooting this podcast in 2024. What are the other things outside of the core billing platform that you offer now? I know a few of them, but like just lay out the product suite that PushPress has today.
Yeah. And I'll preface this and say, like, in hindsight, we look genius doing this, but we really just let the market pull us. And I think this is a very good topic for entrepreneurs to tie into. It's like, let the market pull you, right? Yeah. You guys were the reason we had to build Grow, because when you sold to our competitor, like, we had a nice thing going. And when you guys in SugarWOD sold our competitor, we realized really quickly, like, we have to build a competitor to UpLaunch now. And we have to build a competitor to SugarWOD. We have to, because the market demanded it. That people weren't going to buy a software stack if it didn't have all three, because we started it, us three. And then when Daxco bought you, like, now they had it, right? So it was like very smart for them to do, but it forced us to build Grow, which was our UpLaunch competitor, and Train. We acquired Train because of SugarWOD. That was a pull, right? We got pulled into that.
Yeah.
Branded app was really just an idea that Chris McConaughey had, because he was so infatuated with brand. And our theory, this is interesting, of like learning as an entrepreneur. Our theory with Branded app, and Branded app is a custom mobile app that is branded to the gym. Our theory was like 10 people were going to buy it, but he just really wanted to do it because he was super into brand.
Sure. And he's great at it also.
And he's great at it. Yeah. And, in hindsight, it was a stupid thing to do for our business, because we didn't do any research. We didn't even have conviction. We were just like, 10 people will do it. Who cares? Let's just do it. It was like the dumbest thing to do. But I think as we stand right now, almost 40% of our clients have a branded app, which is unbelievably insane. Like, we far out, just beat everything we ever thought it would do. So that's what Branded app is. And then now we're starting to sell insurance, and insurance is really the playbook of testing the concept of everything I just said. Can we find a product where in the open market, it probably is being sold at a higher price point than it needs to, that we can sell it at a cheaper distribution cost, because we have the right to sell to our customers because they trust us, and we can provide more value in the process of doing so. So not only is it cheaper for them, but they actually get a better experience, better value. And that's proving out. It's proving out right now. So the big epiphany I had over the weekend when I was talking to my partner at the VC was, Geico spends $250 a click on Google ads for insurance. I haven't spent a penny on insurance other than launching it. Like, my distribution is baked right into my platform. So that's kind of the beauty of vertical SaaS right there.
Yeah, dude, that's wild. One of the things that's on my mind, you said let the market pull you, which I think is really good high level advice. But I know you well enough to know that there's probably a more structured way of evaluating product ideas. Because I bet I could hand you a pen and you could write down 30 more ideas for the fitness industry that you want to build tomorrow, right? So maybe when you come up with an idea, or one of your team writes a pitch, what's your process for figuring out, is this a good opportunity, or is it a distraction, or how am I going to test for it? Like, how do you think through that as a CEO?
By and large, every idea that gets put in front of me or that someone comes up with is a good idea. That's the hard part.
That's the problem, right?
Yeah. The hard part is you're not going to have a lack of good ideas. And I think this is where, to some degree, at least being able to say, for this quarter, you have to pick a semi-big time frame, quarter, half, or year. For this period, our focus is X. And that X has to be very clear. Logo growth, ARPU growth, NPS growth, whatever, right? And when you're able to pick that lever or that pivot point is when you could start to make decisions. And sometimes they're hard. So I'll give you an example. Like, let's say our core thesis is we want to grow logos. Okay. I get two proposals. We want to do internationalization, or we want to build, 3 functions that will take us deeper into CrossFit. Those both could drive logos. So now it's like, you've got to get into the memo and start to say, like, okay, well, show me the research. How many gyms are underserved in Korea and Italy versus how many CrossFit gyms are being opened here? What is the cost, right? There's always the cost. What is the risk? So this is where, like, we follow a pretty strict Amazon memo writing process, where it's like, if you haven't done the research now, like, branded app wouldn't fly today, given the work that we put into it. But if you haven't put in the work to back up your thesis of why this is the thing that solves our problem point or our direction, which includes risk analysis, cost, resources needed to be added, chance of winning, things like that, then we can't consider it at this point. We're actually past the point of doing things on gut, right?
How do you teach that to your team?
So that's actually, we're going through the process of now, and it's a really rigorous process and difficult to actually go from, I feel like this feature is going to do well, to I know this will do well. And it does. The hardest part about it is it slows down immediate, trajectory or velocity. And I think the hardest part, what I'm navigating through right now as we speak, is the layers of, while you're increasing your velocity on the things you're doing now, you're thinking about and writing your memo of the stuff for next year, right? And that's how you can keep velocity and make good decisions in the long run. So that's kind of like how I'm starting to see it now, is like, instead of everyone just stopping and writing a memo for 6 months and like nothing happens, you've got to be like multi-layered, where you've got a layer of people who can execute now. And usually it's the people managing the execution, the ICs that are executing. They need to be able to step back and go like, well, Dan, what do we want to do in 2025? Okay, that's the thing. Then let me start to write the memo for 2025 so I can build the team. This is the thing that blew my mind, I guess, in the last 18 months, is like, you have to build the team in 2024 to do what you want to do in 2025. Right. And so normally in the entrepreneur journey, it's like, you're just doing whatever the hell you're doing right now, and you'll deal with tomorrow. But in order to keep the velocity going, it's like, you have to have the foresight of knowing where you want to go next year, and concurrently build the team that's going to get you there while you're moving towards that. I like to think of everything as like military analogy, because it's just works for me. And it's like, if you got to go fight this battle over here next year, you've got to be training your soldiers today. You can't just be like throwing people on the battlefield, when the battle starts. So that's kind of how you got to think of the cycle. Dude,
so that's awesome. I want to read this one thing back to you that I just got from this conversation, because I just think it's really important. I think that, I've talked to a lot of founders, and we're going through this ourselves too, where we're in the midst of leaning into a culture of writing, right? And trying to get the memo process down and trying to get better clarity of thought. And you're right, because, you mention velocity and throughput and staying agile as a larger company on one hand, and it feels like it's in tension with slow down and write memos and think this through. And so what I just took from this, what I learned is that the velocity is kind of time boxed from today to, 6 months downrange roughly, right? Where the stuff that's in flight, go fast, stay focused, ICs are charging ahead, the management layers kind of splitting their time. And the clarity, the writing, the depth of analysis isn't a now thing. The next couple of quarters are already baked, and you need to write these memos and do this thought work for the next half of the year, the next year, the next 2 years. And so it's like applying the right tactic to the right time horizon. Yeah.
Yes, exactly. And that's the hard cycle to break out of when you're in the run through walls to do everything, like try to get till Tuesday phase. So that's like, as the leader of a company, the big reinvent of yourself is that like we're always paying back some shit we burned up yesterday. Like there's that cycle. And then there's like really getting ahead of yourself and saying like, we need to get 2025 lined up now. Like we're doing our 2025 annual planning now, which, might even be considered a little bit late. We probably should have done it in June, but that's because we have to have the plan baked by October so I can hire the team in Q4 and have them on board and ready to go for January 1, right? That's how we think about it.
That makes a ton of sense, man. One of the other things on my list that I wanted to talk to you about with this multi-product strategy, because it's something that comes up with a lot of our like boardroom clients is, they're starting to launch second and third products and they're curious about how it works. What's your overall strategy for pricing and packaging the suite? Like, do you sell everything as add-ons? Do you bundle? Have you tried both? Like, what's the right way for you to think about pricing once you have a whole bunch of different products in a similar market?
Pricing can be a whole podcast, and there's a lot of variance. There's a lot of variance to this, a lot of variables. So it really depends on who you serve. First of all, we serve SMBs, and from my personal experience, SMBs are very price sensitive, and especially like usage-based pricing doesn't work for us. And a lot of like the more they feel nickel and dimed or upsold to, the worse. So there's that to consider. If you're selling in an enterprise, you can probably go usage based. You can probably stack a whole bunch of pricing because the person making the payment is not the person whose bank account it's tied to. In the SMB, it's like, I'm the one paying for this. So if I feel like you're nickel and diming me. So again, vertical SaaS is the foundation of vertical SaaS is trust. So if you create your pricing package in a way that like de-incentivize trust, you're in the long run, you're screwing yourself 100%. So in my business, the way we think about it is there are additional packages you can buy based on value sets that we provide, but each one carries an increasing discount. So it ends up in your brain becoming a package price, but everything gets incrementally cheaper as we go. And the reason, I guess you can say, one of the primary drivers that our branded app has like 34% or 40% adoption or whatever is because by the time you get to adding the branded app, it's usually the fourth thing that people will buy. I think the branded app ends up being like 80% off because it's just like that discount stacks and stacks and stacks. And they're like, well, I guess I'll just get that for like 20%.
Might as well. Yeah. Got it.
And that wasn't from the intention so much of like trying to jam people into buying more things. It's just like, we know when you think of the entire price, like I'm buying 3 things, 2 things, or 4 things, and the price just comes to this. That's just an easier way for them to like understand the relationship. In my opinion, pricing should be set so that you're getting at least 5x value, demonstrative 5x value on whatever you're paying. That's how you reduce churn.
Have you, as you've kind of branched this out, I mean, obviously your, overall client value increases the more products you're selling. Have you had any tension you've had to manage around just like overall wallet share of your customers, like gym owners being like, man, I'm paying PushPress a lot of money, even though I'm getting all this stuff, or like, how have you had to deal with that tension in the market?
I think in general, that's always going to happen. And I think the way you battle that, which we don't do great enough yet, is you need to provide clear value on the flip side of it. So for instance, pretend you had a relationship with, I don't know, Amazon. And it's like, for whatever reason, if you knew, okay, if you're a Prime, right? If it's like every time Prime renewal comes up, you're like, whoa, it's $175 now, whatever. But then it's like, oh yeah, but you watched 18 free movies and you had, you had this many shipments come for free and they do the math, and it's like, well, that $175 really was like $4,000 you saved last year. That really takes the bite. Like without that $4,000 side of the equation, you're like 175. I don't know. Do I need it? So I think that's that in the SaaS world. That's what you need to do. It's like whatever your chart. That's why I'm saying 5x value, right? It's like if you're $200 a month, you better have something that shows them that like you just saved it. You saved or gained $1,000 by spending this $200. You know?
Yeah. I think that's like for people designing products, or even if there's earlier stage founders listening to this and they're still figuring out what product to build, it goes back to what you said around like building the platform system of record first before you start to branch out in industry. This is a challenge that I had with UpLaunch in the first company. Is it was difficult to do what I now call closing the ROI loop, right? When you're doing the transactions like you are in PushPress, you can do it very easily because you have a data feed of how much money they're making, right? And so you can like show the return on investment very, very clearly, just like the Amazon example. If you're building a product where you can't do that, or you have to rely on like self-reported data or perception of value, it gets to be a lot trickier to overcome the wallet share phenomenon. Yeah. You know, I thought Baremetrics did this really well, like the subscription analytics over Stripe that I used. I used a payment recovery add-on. It was the most expensive part of my Baremetrics subscription. They were like, look, paid us $8,300 and we've gotten you back $68,412. And I'm like, all right, I'll keep paying you. Easy.
Yeah. Yeah. Which they've kind of backed into a usage-based pricing because it was like, you just pay us 10% of what we recover or whatever it was. And so, yeah, you're like, shit, I just spent $900. And they're like, well, we recovered 9,000 in MRR for you. So figure that out. So you can't quit.
Like, all right. Yeah. Yeah. They got you. Oh, I love it, man. All right. So I want to talk about team for a minute and culture, because you know, that's something that I've admired about you since the startup days when we were, you know, doing the retreats together, is like the culture always seemed pure. And you've talked about that a lot on this podcast, right? Like advocating for the little guys, you're hiring people whose, you know, parents might own laundromats, like that kind of thing. You put the label on the bottle really, really well, which is interesting. But then I was watching some of your content on TikTok, and you did a little video about something called the keeper test, and it stirred up a little emotion in some of your followers that we'll talk about in a sec. But for people who are listening to this and they're not sure what the keeper test is, let's start with that. Can you explain what you were talking about there?
Yeah, the keeper test is something I think Netflix invented. Basically, the bottom line is this: it's like if you're managing somebody and they come up to you and they go, "Hey, I just got another job at insert other company. Want to thank you for the time here. Just want to let you know I'm putting in my 2 weeks." And if you're the manager and you go, hold up. And you go to your boss and say like, hey, Matt's about to leave. Like, what can we do to, like, I need a raise. I need some stock, whatever. That person's a keeper. Like if your inclination is like, hold up, let me fix this. What did we do wrong? Let me fix this. That person's a keeper. If you're like, that sucks. Have a good time. You know, like, it was great working with you, and you let them go, they're not a keeper. Like you're probably in the back of your mind going, oh, cool, I can now hire a better replacement of this person that I've been meaning to do for a while. And so what Netflix does is they actually surface this in their monthly reviews cycle with their employees. I don't know exactly how they do it. In fact, I don't think they have monthly reviews, but there's a forced mechanism that makes a manager tell a reportee, you're not a keeper, which I think, you know, ruffles a lot of feathers. Like, oh, great, you're going to tell me I'm not a keeper? But really, you can look at this as half glass full, half glass empty. And honestly, I'll just say this bluntly. If you're not a keeper, you're going to be offended by that. And you know if you're not a keeper. Like I wasn't a keeper when I worked at my other job because it was like I came in, I wrote some code. Oh, well, they want to do a meeting. I'm pissed off because I want to go home. You know, like it's all about me. I wasn't a keeper. And I probably would have been pissed off watching that video at that time because it's like, oh, like that's really inhumane. And you know who actually would probably thumbs up that video are keepers, like people who come in head full of fire, like want to change the world, like super passionate about what we're doing. They'll be like, hell yeah, like I want you to respect me. I want you to give me proactive raises, right? Like, why wait till I quit to give me a raise? So that's kind of the keeper test. That's why some people were offended by it. I don't think I actually think if you look at it from a certain lens, it is actually more empathetic because you're proactively taking care of the best people and you're trying to create systems that reinforce hiring and keeping the best people.
That's interesting. Yep. And so you're saying that the people who should stay on the bus will be happy to get that feedback. And is there a situation where somebody might not pass the keeper test, but can get out of that 100%. Position and
that's the whole,
level up?
That's the whole point of actually talking about it, because You're just saying like, hey, right now you're not a keeper. And then the conversation should go, then the employee can take it one of two ways. Oh, woe is me. I'm not a keeper. This job sucks, right? You're not a keeper. You're definitely not a keeper. Or, oh shit, what do I need to do? Like, I didn't realize, like, tell me what I need to do. Like, how can I become a keeper? And then it just becomes a really easy conversation for the manager to say like, well, I just need you to be a little more assertive in meetings. I need you to take some more ownership in your projects, and like too many bugs. Yeah. Right. Okay. Let me fix that. Okay, cool. Like it just creates a constant. So what sucks about the review cycle is like you get no feedback for 6 months. And then it's like, well, you're like, you didn't get a raise and you're up for being fired because you have these problems, as opposed to being, again, it's just pushing the feedback loop faster. Right.
Yeah.
Like,
that's what I was trying to draw out is, there's two ways to fail a keeper test, right? I feel like you can fail it on performance, which is recoverable. I need to fix better bugs, show up more assertively in meetings, or you can fail it based on culture or values, which is usually, in my experience, not a recoverable thing. And a lot of that comes down to taking feedback, like in your example right there. I've seen it put on a matrix. You've probably seen this too, right? Where it's like the y-axis is true belief and the x-axis is performance in your role, right? And it's like, in which area are you deficient? Because one of those is more recoverable than the other. Does that resonate?
Yeah, absolutely. And again, I don't think there's bad people in the world, but it's like, if you come into my company and you want to, financially engineer success and like do all these things that are like, just go be an iBanker, like, or go work for a PE backed company. There's nothing wrong with that. It's just not how we run this company.
Yeah.
So like, I actually think in if we want to talk empathy and humanity, like, I think that's better for them. Like, find the people who aren't culturally the right fit. They shouldn't even be there to begin with, because like your hiring process should root that out. But they get in. What's the fastest way to identify that and say like, hey, look, man, not a bad person. In fact, Martell taught me this. It's like, you're not a bad person. You are a bad fit. And we will each be disserving each other for longer that we let this happen. So let's just fix this now. Let me go. I'll be a referral.
We say that all the time, right? Yeah. It's like by not doing the uncomfortable thing and making the change you need to make on the team, you as the leader are standing in between that person and a role that they could crush at. Like, you are holding their career back by not being courageous enough to have the conversation.
It was that teaching by Martell that really got me thinking down that path. And let me tell you something else I figured out. You're really hurting the good employees on your team too. Because if you're tolerating someone who's like underperforming, everyone's going to sink to that level pretty quick. So like, you have to actually show the team that like, this is not what we accept here. And we want everyone to stay at this high level and not sink to the low level. So yeah, it's the quickest way to make a great employee crappy, just put them around crappy people. I shouldn't use the word crappy because that's judgmental, but to make a great performer underperform, put them around underperformers.
Yeah, and the ones that aren't willing to sink to that level will just leave and go somewhere else where they can be surrounded by A players.
Exactly.
So two outcomes, both bad. Dude, I love that. How did you, how did you get so clear on the values of PushPress, right? Did you wake up one morning when it was still getting run out of the gym and you're like, these are my core values, or has it evolved over time? Like, how do you get where you are?
The core value thing is such an ironic thing, because I think, cerebrally, we make it out to be such a big thing. And then we go and like, look at what other people have written, and you know what I mean? Like, we do all this stuff, and I've done it too. In fact, our core values, I'm very attached to the way Amazon's run their business. And a lot of our core values are just Amazon's, because they've just done it right. But the reality is, like, if you're starting a company and you're trying to do this core value process, it's no more difficult than just saying like, what do I believe? What kind of company do I want to build? Like, and it's tough because we keep going back to cliche, like, the customer is always right, or whatever it might be. But it's just really, you have to just think about what you believe. Because like I said, it's okay to say like, the customer is always wrong and I want to make a ton of money. I mean, if that's really what you believe, you want those people around you that believe that too, right? Like, you don't want a bunch of customer empathetic people who like don't want to make money. So I think it's like, you can just strip it down to that. Like, just as simply like, if I really had to just write down my core beliefs of how I want to run this company, because it's your company, that's all it is. It shouldn't be any more contrived than that.
No, I agree with you, man. And I read something somewhere. I wish I could remember where I read it so I could attribute it. But it was this idea that a core value is a great core value if the opposite of it could also be true. right? And the example was Facebook's classic, move fast and break stuff, where it could be, be very meticulous and minimize downtime. And that would also be reasonable. If your core value is like integrity,
Yeah.
the inverse of that is like, we're all pathological liars. Like it's probably a shitty core value,
Yeah, that's
right?
a good
So
one. I never thought of it that way. This is really good.
it's an interesting test. Cool, man. So I love it. I got one more big area that I want to get your take on while we got our time together. And it's everybody's favorite topic and sometimes everybody's least favorite topic, and it's money. Specifically raising money, because you've had an interesting journey. I think you did a small seed round, super back in the day, but you were primarily bootstrapped through the rise of PushPress all the way through. And then recently decided to take on funding and raise a Series A. And so I would love to know, we'll talk about the process of that here in a minute, but I would love to know first from your perspective as the founder and CEO, like what did you believe when you were bootstrapping and what changed to make you switch your approach?
Yeah, I mean, I will say this from the get-go. I tried to raise money the whole time I was bootstrapping. I just couldn't. For a myriad of reasons, which we can go into if you want, but I couldn't raise money. Was not like literally able to. So my belief all along has been there is enough opportunity in the business we're building. There are enough customers who are unsatisfied with the companies they work with. And my strong desire to be the world's best gym operating system and, whatever other ancillary services we build for gyms in a holistically positive way. Like I want to build a company that actually defends gyms and has their best interests out for them.
Yeah.
There's no other there. I mean, maybe now I could argue that there are a few competitors coming up that might have that same mindset. When I started this, nobody I really believe care about gyms were I was competing against. So I knew all along if I was able to build the product that could compete or beat those and have the empathy and values that we have, we would win. We would win, and it would be better for the customers that we did. That's why we had to raise, because we needed to speed up the ability of which we can build product. It was just so slow in the beginning, and the reality of it is this: is like when you're bootstrapped, you have to hire whoever you can hire. And what I've learned over the years is it's better to hire one rock star than 3 non-rock stars. Like it's better to spend 300 grand on one person than 3 times 100 grand on 3 people.
Facts,
just to make the math easy. I don't know if those are the right numbers, but
yeah,
like hiring many non-rock stars put us back years.
Really?
Yeah. Like just created worse product, created landmines, right? Like, so we're not doing that anymore. And that's why we raise money, because it's just like, we have to stop hiring whoever we can afford and start hiring the people that we've handpicked to do the job and who are highly capable. So
I think it's a really salient point, man, because I think that people, and I try to coach founders out of this constantly, right? Where like headcount is not a metric that you should, I feel like, strive to achieve. I feel like you should
minimize headcount.
Minimum headcount. Yeah. Yes. Minimum viable headcount. We're coining that term right now. So, right. And it's like, I think people, they look at productivity of employees as this like linear progression, right? Where 10 engineers goes 10 times faster, and they fail to realize the communication overhead, the management overhead, the differences
siloing that gets created, everything. The human drama. Yeah. Yep. It's
minimum viable headcount.
Yeah.
So, all right. So it wasn't a decision then. That was new. It was a decision the whole way, and you had to get to the point where you finally could get the round done, right? Like what had changed in the business that made you quote unquote fundable at that point? And what was that process like raising the money?
God, there are so many dynamics I think that changed that really all came together. One, when you have a business that actually has enough clientele and enough revenue, it takes away some question marks from investors. And at the seed and the Series A round, they're investing more in the idea and the premise than they're investing in the machine of the business. Mm-hmm. So we had grown through COVID. That was another proof point. Is like we went through this crazy moment where all the VCs were like, "This is what is going on?" And then when they see companies growing, it becomes an immediate attraction point. I think honestly, and if you're a founder out looking to raise, I think this is a good point. I became fundable. Like before, so when we tried to raise in the first 8 years, my co-founder Chris was the CEO for a while. Brian was the CEO for a while. I was the CFO for a while. It was like we were just like, who can do this? Rotating through the positions. We used to get feedback like, we like the company, we like the idea, we don't see the passion. And we were like, we're so passionate. What do you mean? But it was like we were scared to pitch, so we were like trembly voices, timid people. Like we didn't really have the vision packed out. I've been at a point now where it's like half of my job is just staring at a screen and thinking about 2027. You know. So it's like, if you want to talk about like all the nuance, like I have the models, I have the visual representations. Like I know where PushPress is going now. Put me in front of an investor or somebody and I will tell them, and it becomes investable because it's just like with confidence and track record. This is what we've done. This is what we're doing. This is how we're going to do it. You know, this is the vision. This is what happens 10 years from now. Take it or leave it. That just like that type of confidence is so different in a pitch than, we're building, like, how are you gonna beat MindBody? Oh, we're not really sure yet. They're, like, we don't, like all that shit. So, if you're looking to get funded, your confidence in the story, like my chief of staff told me this, Elon Musk will go raise $100 million for a new napkin brand right now because he'll pitch the hell out of it. And he's Elon Musk, like you could have a life-changing revolutionary business, but if you don't have that cachet behind you, you're not raising anything. So it's at the end of the day, investors are emotional and they invest in confidence.
Dude, I love that. And it seems like a really clear example of flipping the power dynamic, right? Between the way that I think inexperienced founders look at this of like asking for permission, where I loved what you said about, this is my vision, 100% confidence. I'm going here with or without you, take it or leave it, right? I mean, that's a totally different lens.
Yeah. And it's something you just have to develop over time. And it's like everything in life, it's reps, right? Like eventually you're going to get told no enough that you realize that like, oh, it's pattern recognition, right? Like I've seen you before, you're not a good investor for me. So let's just not waste each other's time. Or versus like, like once you've done it enough, you're just kind of like, I know you're a good investor. Here's what I do. Like, let's just shake down and get to the brass tacks. What do you think? And I think when you approach it that way, it's just all of a sudden investors are like, it's like dating, right? It's like if you're dating someone, they're like, kind of wishy-washy. You're just like, I don't know. But if they're just like, yeah, I'm a catch, and if you want to catch this, you can, but you tell me. If not, I'll just go over there. Then all of a sudden you're like, oh, hold on, right? So
that's funny, man. And so one of the ways that I think you're different than a lot of the people I talk to is that you have a really high degree of respect and admiration for the VCs who invested in your Series A. And I don't always see that dynamic with some companies. There's a lot out there about, every investor is a value add investor, blah, blah, blah. And, I talk to you, overwhelmingly, you say that it's been a good experience. So my question is, how did you know when you're pitching all of these different investors trying to raise money for so long? Yes, you became fundable, but how did you know that they were the right people to take money from?
Yeah, because just to answer that as succinctly as possible, all the red flags we got talking to investors, which is probably all of the stuff most founders are afraid of, it was opposite with this investor. And what I realize now is they're out there, they're a little more hidden, and they're 1 in 50. Most investors don't fit this profile. So here's like the should I get funded, should I not get funded as a founder conversation. If you're operating in a space where like it's winner takes all, you have to get funded, and you have to get funded by a high bet taker, which would be Sequoia, A16Z, Lightspeed, those kind of guys. Those companies want to return the fund on a couple companies and invest all their energy in those couple companies. So they want an Uber, they want an Airbnb, they want a Facebook, they want, I don't know, the next AI company. However, their risk profile is such that they will burn down all the companies that don't return. And by return, we're talking like 10, 20x plus, 50x, like mega return. So they're willing to invest in 1,000 companies and have 3 return. Then you have to know when you play that game, your odds are about 98% that they will burn you down. Because the only way to really test, you got to think of every business this is their business. So in your business, it's like, how do I get a customer? I need to test their response. Da, da, da. Their test is like, can this go 50x? And so it's like the only way to test that is to burn money. And they have all the money in the world to burn. So they're like, okay, go hire a bunch of people, burn it. And in 1 year, I want to see if you can get to here. Okay, cool. You did it. I'll reinvest. Right. But now you're on this burn hamster wheel. Anyway, that doesn't support my business model. My business model is win over 25 years. Right. So I have this concept of durability baked into our business. Like we have to survive next year because the next partnership might come along or whatever that is the next growth lever. That's how I've always seen it. When I talk to this investment company, so eventually I'm like, hey, we got to raise some money because like we can't keep nickel and diming, just barely getting product out. We have so much to do. So I decided to go on the road and see if I can find another investor or an investor. When I did it, I happened across this company called Altos Ventures, and they were just unique. Like they were basically pitching me on the concept of durability and responsible capital allocation. And I was like, well, you don't want me to burn money fast? They're like, why would we want to do that? Like the only way you can die as a company is if you spend all your money. So why would you spend all your money? And I'm like, wait, what? Like, yeah, like,
yeah. Are you guys okay?
Yeah. They're like, no, let's just test some things with a little bit of money. And if it works, like, then you can double down on it. Don't just go all in. They showed me like the power log graph of all their funds. Right. And this is when I thought I was pitching them, but I realized it's like they were also pitching me. So that's another part of this whole pitch process that you'll understand as you do it more. They need you as much as you need them. So it's like they're pitching you too. So anyways, they showed me this graph and it was like, they invested in Roblox. They were like the first money in, the biggest money in. I think they invested like 500 million into Roblox before it went public. Damn. Roblox was like on the graph. It was like the whole damn thing. Right.
Yeah.
And then there are a couple more that were like really, really high. And then pretty quickly it goes down and to the left. Right. And in a normal VC, it's like anything that wasn't those first 3 or 4, it's like, okay, just kill those companies and like, let's keep putting more money towards Roblox. Their pitch to me was like, these first 4 over here, those are great. Those returned our funds and then some. But you know who we care about? We care about all these other companies because that's the founder's life work. And I'm like, they're talking to me, right? Like I'm like a decade in at this point or like 8 years in, right? And they're like that, even if we only get 300 million return or 500 million or maybe even $1 billion return, like compared to Roblox, nothing, who cares, right? But to that founder, that's everything. So we don't just burn down those companies because like it won't really make a difference in our portfolio, but for the founder, that's everything. And we have a responsibility to every one of those founders to make sure that we don't kill their companies and we get them to where they need to go to. And at that point, I'm like, sign me up, right? Then go. They started pitching me about like inputs and outputs, which is like a whole nother podcast we can do because that's how I think about life now. But they were like, all of the VCs I talked to were like, how are you going to double next year? How are you going to triple next year? We need revenue. They were like, revenue solves itself. Don't worry about revenue. Worry about value. How are you going to create more value? How do you measure the value you create? How are you thinking about that? Right? Because if you solve the value end of the equation and you're doing the right things, you're going to double. You're going to make more money. But if all you're focused on is money, you're going to make all the bad decisions in the short term and you're going to end up like screwing yourself next year. So just focus on value. So it's like, as they're unpacking these gems on me, I'm like, this is the VC I never thought existed, right? Like they see the world as I see it and this can work. So thankfully and luckily, like they bought into us as much as we bought into them. Best partnership ever. I am definitely an example of a company that can excel with capital behind you that is aligned. Alignment is the key. You have to be very upfront on like what. So now if I ever raise money, I'll ask people, what's your expected outcome? What would be bad? What would be good? What type of return do you want in what timeline? And if they tell me like, hey, we want 3x return in 5 years, I'm like, we're not a good fit because I'm working on this for 10 or 12 years from here, at least minimum, So yeah.
I love that, man. I feel like Altos is about to get an influx of people who listen to this episode trying to raise some money.
They're great.
That sounds awesome.
I can make an intro. So again, all these tips, right? If you're looking to raise money, get an intro from a founder that they know. So if you hit me up, I'll take some time to learn your business. I'll tell you like not a good Altos company. If you're a good Altos company, then I'll pass it along to them and you'll get a meeting. But if you just try and cold hit them, you probably won't get a meeting because they get 100 cold hits a day.
Yeah. No, that makes sense. I'd love to go backwards for just a second on something that you mentioned. We talked about all of the good and all the things that you love about Altos and the way that you guys were super value aligned, which I love. But you said something before we got to this part, which was, they had none of the red flags that all the other investors that you talk to were. And so I'd love to just have you unpack what are the red flags as a founder that you might see when you're pitching investors.
Well, again, these are red flags for me. So this might not be red flags for everybody. Depending on your own business, like these might be perfectly fine, right? And I do think in the winner take all environment, all of these quote unquote red flags I have are probably valid things to optimize for, right? So a lot of them did not care about value creation. A lot of them did not care about, well, more than a lot of, like all of them, except Altos so far, did not care, only cared about revenue, production. Many of them zero in on gross margin and profitability, I guess, predictors, right? And so what all that tells me is like, they're less worried about how do you actually build a great business that provides strong value in the world. Because I think you can do both. You can build a strong business that is also profitable, that also has good unit economics, that also generates revenue. But when you're focused on those things first, it's like you're forgetting about the strong business part, right? And so to me, like I would get into term sheets with people. I've turned down multiple term sheets on things. And it's like I would get into term sheets with people and their conversation would immediately turn to like, let's talk about how you can get 30% revenue growth next month. And I'm like, next month, like, where was that coming from? And why do you think that's going to happen? Like what the. And so it's like, you have to be realistic about what your company is and what you're trying to achieve and what timeline you're trying to achieve it on, and just make sure they're aligned with it. And these are all red flags for me because I knew I was building this is going to be probably my last company. I'm not going to build another one, so it's going to take some time.
But the reason I asked specifically is because I'd venture to guess the majority of founders who listen to this podcast are more closely aligned from a value standpoint with where you are and your viewpoint on your company versus winner take all. I'm going to go build the next Uber. Not to say, and again, I agree with you. There's nothing wrong with either of those models, but I just know our community and our listenership, they align a lot more closely with the way you're going about
Yeah,
things.
exactly. Yeah. So we're all bootstrappers probably for the most part who could use some capital to grow their business. Yeah. It's like, you have to find VCs. And honestly, I think it's becoming more, especially since the downturn in the last year and a half, it's more in vogue now to say like, we're focused on unit economics and not growth at all costs. We're focused on long-term, wealth or growth building with our portfolio companies. That's more in vogue now. The thing to me that's scary is like Altos has been saying that since 1997, consistently, nonstop, every year. And now it's like there's a whole bunch of them saying like, oh, no, we're worried about capital efficiency and blah, blah, blah. So it's like those companies will just flip right back around to the growth engine when interest rates go down or whatever.
Yeah. They're worried about it because they can't be worried about the other thing because of the economy.
Again, it's what's driving revenue for them. So it's like, okay, we'll go over the revenue is. We'll do it like, I don't know. To me, it's just like, it's kind of sell your soul, right? Like just do whatever. So, that's the thing. Altos Honam, who's one of the main partners there, told me when I was there, he's like, Warren Buffett's been saying this stuff since he has a quote where he's like, I've been telling everyone to do the same thing since 1950 or whatever, every year. And then every year people come back to me and say like, what should we do? And he's like, I've said the same thing every year, but everyone wants to go chase Bitcoin or whatever the new hype cycle is. And instead just keep doing what I'm doing. So it's like the low key kind of approach to, I guess, the way that they see investing. Yeah.
Dude, I love it, man. We've covered a lot of ground on this podcast, from humble beginnings to almost hanging it up, product strategy, planning in decades, culture, raising money, man. We hit it all. And I've got a question that I ask to end most of the podcasts that I do. But before I do that, if people want some more Dan, like where do they go to find you? I know you're doing a lot of content. You got PushPress. Like where do you live on the internet?
Yeah, I think the simplest thing, pushpress.com/Dan. Believe it or not, I have a landing page for myself. How funny is that? No, that's the best place. I do put out a bunch of content on TikTok and Instagram. There's links from that page there. I have a smattering of different handles because who can get the same one nowadays? So it's probably better just to go there. Pushpress.com/Dan.
Rock and roll. I love it, man. And you are mentioned in our new book that's coming out, by the way, which is cool. I'll have to send you a copy of that. We got some PushPress /Dan action in the book too, which will be super fun. But cool. All right. Final question, my friend. If you had to pick one thing what do you want to be remembered for when it's all said and
Oh
done?
man. I think in the end, I would, anyone who has interacted with PushPress as a client or especially a team member, just sees me as someone who was just hyper vigilant and massively passionate about building the best company, not only to serve our customer base, but our staff as well. Yeah, I'm a human to human person that is reflected in the company. And so it would have to be something along those lines.
Dude, well, I can tell you as someone who's been watching your growth for quite some time in a lot of different capacities, it's a big old plus one for me, man. It comes through in everything you do. And I'm proud to be able to call you a friend
Yeah, me
and
too,
watch you
Matt.
keep on crushing.
It's been a journey.
Yeah.
Thank you.
Yeah, dude. I love it. Thanks for sharing some time with us, man.
Okay.
I appreciate you, brother.
All right, me too. See ya.